strong focus on execution, and I am very happy with the progress that we have made and the results that we have achieved. We delivered on reported basis a growth of 3.5% to $2,587 million, and on constant currency a growth of a little bit short of 4%. So I'm happy with that. On margins, we grew by 80 basis points to 24.9, and our utilization went up to 82.5%, which is a high for us over the last several years. And the key factors that had contributed to the less than desirable performance that we had in Q1, we have managed to arrest those, to the degrowth on those, which is consulting, BPO, as well as Finacle, and parts of our India business. So I'm quite happy with the progress that we achieved. Also in other operational parameters, like in various aspects of operational efficiency, subcon reduction, the on-site role ratios, and things of this nature. Also in large deals, we crossed $1 billion. We did a little bit more than 1.2 billion in large deals. A large percentage of that was in the framework deals. Also in large accounts, as well as in the additions of the 50 million plus and 100 million plus accounts, we continue to make progress. So I'm happy with the performance that our team delivered in this past Q2. While there are quarterly ups and downs based on a variety of factors, what matters really in our industry is the structural change that is going on in our industry, and I have talked about this for the last 2 years. And the signs of this change are very visible, very abundantly clear as we look around. And I believe that our strategy is quite distinctly different than the strategy of many of our competitors. And I think that you can start to see the strategy differences play out in the results that we are achieving. The key part of the evolution of our industry is going to be to evolve from a people-only model towards people plus software, where people are amplified by software and by automation. And that improved productivity and automation is then leveraged towards innovation, towards people becoming innovative, both in top-down innovation in structural areas like strategy and consulting, as well as grassroots, grounds-up innovation coming from the people. And on these all-important fronts, we are continuing to make progress, and that is what will change the overall equation for us as we evolve towards a next-generation company and away from the model of the past that we have had. Also, to help us set ourselves up for this, about 18 months ago, we established a single defragmented delivery organization under Ravi's leadership, and that has showed tremendous results in the last 18 months with the increased focus, improved bandwidth, defragmentation, and ability to focus on client needs. We are similarly now doing the same on the sales side. We have 3 presidents, Sandeep, Mohit, and Rajesh, and under their leadership, we are establishing 15 or so industry heads who have a sharp accountability, a sharp focus, and a sharp agility to be able to respond to market needs and bring the best of the entire Infosys to bear on the growth that we endeavor to achieve in the next several quarters. So overall, a good quarter, a great focus on operational and execution parameters, and broad overall good result, and a difficult time in a structurally challenging time for our industry. And so I'm quite satisfied with the result, and beyond the quarterly results, I am quite happy with the progress that we are making on reinventing ourselves for the future. So with that, I think we can take some questions.
Hi, good morning. Chandra Shrikant here from ET Now. I have questions for the 3 of you. I'll start with Vishal. Vishal, you know, this is the second time you're cutting guidance this fiscal year. So, I mean, how are you really going to repose confidence in investors about the predictability of your earnings? Are you fairly confident that you will stick with 8 to 9% for the rest of the fiscal year, you know, based on the demand that you're seeing? Secondly, at this rate, do you see a need to relook your 2020 targets? You said that you will look at this by the end of the year. And thirdly, if you can take us through the restructuring that you just mentioned in terms of 15 industry heads, won't that be a distraction in the current environment where growth is becoming difficult? Praveen, just to understand, in terms of how you performed on large deal wins and what really helped you in terms of geographies, sectors in this environment. Ranga, margin expansion, but how sustainable is this given that you don't have growth to support margin expansion and going by the trend, that's what it looks like in the coming quarters. So what other levers do you have to continue this margin expansion? Thank you so much.
Hey Chandra, on guidance, our belief is to ensure that there is absolutely no or as little as possible asymmetry of information between what the management sees and what we share with the market, and we have always endeavored to do that. We live in and we operate our business in a dually volatile atmosphere. One is based on the transformation of the company based on what is going on in our industry, and the other one is what happens in the outside atmosphere. And both of these contribute to our ability to forecast over the course of a year and so forth. So based on the visibility that we have, as you see over the course of the last quarter, we mentioned some of the client behavior related matters such as the RBS decline that we had and similar some client specific things. So those have contributed to our outlook on the remainder of the year, and that is what we see right now, and that is that's what we have shared. As far as 2020, that has always been an aspiration. What is the point of an aspiration if it is not something that we can aspire to? We are sticking to that 20 billion, 30%, $80,000 revenue per employee. Look, it is the yearly and quarterly guidance and the forecasts and the plans are based on what we see currently in the present atmosphere. But the future cannot simply be an increment of the present, and the future is something that we have to set a target that if we are able to execute on our transformation, then what is the number that we should aspire to, and that is the number. So we are obviously we are sticking to that. And in terms of the organization, we operate by verticals. Our go-to-market is based on industries, and being able to deliver compelling value propositions of both the renew and the new. Not only our renew and our new, but also our clients' renew and new. And that we need a sharp focus, accountability, and agility in being able to get there. And therefore, we have organized under the leadership of our three sales presidents, Sandeep, Mohit, and Rajesh. We must keep in mind that beyond their responsibilities in verticals, they also carry global responsibilities. For example, Mohit runs all the sales operations for the company globally. So all the operational aspects of sales are his, not only in the vertical areas that he's directly responsible for. Similarly, Sandeep is responsible for bringing all the new services and software across the company, and Rajesh is responsible for ensuring that the strategy and consulting part of the work that we do is global in nature. And so they will continue to be responsible for those global functions as well as their industries. But now with the 15 or 16, Praveen, what is the exact number? Is it 15 or 16?
It's unlucky 13.
It's 13. 13. With the industry heads, we will achieve that accountability and that agility. So I think that will go hand in hand with the extremely, with the amazing job that Ravi is doing, running a defragmented delivery organization where we can bring the power of automation as well as grassroots innovation to bear, and you see the results that is delivering.
Yeah, just to add on Vishal's thing on the sales restructuring, in delivery also under Ravi, we already have about 13 leaders. And we did this about 18 months back, and it has worked well, and so we have now extended it on the sales side, on the market side. Now coming back to the large deals, we won 6 deals, 2 of them with committed revenues totaling to about $138 million, and 4 framework deals, $1 billion $69. So total of about slightly over $1.2 billion. This as compared to about $880 million we did in previous quarter. So it's large deal win continues to be good. The pipeline continues to be healthy. In terms of the overall commentary on the services and the segments, overall it has been a broad-based growth. We had, from a geography perspective, we had good growth in the rest of the world. India, we had a good growth. It was one-off on the back of a GST project. Then on Europe, on a reported basis, it was just about 1.1% quarter-on-quarter growth, but on a constant currency, it was 3.7, almost close to Infosys growth. Only Americas was a slightly moderate growth. It was about 2.2% or so. But barring that, I think by and large, growth has been uniform across sectors. And from a services perspective, we continue to see our core IT services doing extremely well. They have grown much faster than the organization. Even last quarter, they read that we had a 4.6% reported growth on the core IT services side, led by good growth in engineering services, testing services, infrastructure management services, and application development. On the industry side, we have seen good growth in ECS, over 6% quarter-on-quarter growth. All three segments, energy, utilities, as well as telecom, have done extremely well. Financial services, despite all the challenges, we have seen good growth, both financial services as well as insurance. Manufacturing has been moderate. Retail has been just average, just marginal growth. But having said that, while from a growth perspective, while it has been marginal, on an incremental revenue perspective, we have done well on retail. And in terms of the market share capture, I think we have done reasonably well capturing market share in this space from our competition as well. Overall, net-net, I think it has been a fairly decent growth across segments, across service lines.
Hi, I think Q2 on the margin front, we've expanded the margins by 80 basis points. And I think I would certainly attribute this to our very sharp focus over the last couple of quarters on the operational efficiency parameters which we have been focusing on. As Vishal said, utilization, and we've always said that, look, it used to be in late 70s as recent as about, FY15. And we said, look, we'll focus it to keep it consistently about 80%. And last 6 quarters, it has been about 80%, and this quarter, 82.5. And the other indicator, as you know, is the on-site effort mix. It used to be 29.9 last quarter, and we have seen that declining to 29.7, which is again a positive movement for us. And of course, the on-site employee cost optimization continues. That has helped us. And more importantly, even the subcontractor expenses, which used to be 6.3% of revenue in Q3 of last year, we said we would bring it down, moderate it without hurting the growth. So it has come down to 5.6 and 5.4 now. So overall, I think in this quarter, there has been a continuation of our sharp focus on operational efficiency, which helped us in improving the margins by 80 basis points. And as you rightly pointed out, I think margin is an outcome of 3 key pieces. One, of course, is the revenue growth, and the second one is the pricing, and the third one is to what extent the pricing declines we could offset through operational efficiency indicators, whether it is subcon, whether it is utilization, whether it is on-site mix, whether it is on-site role ratios, and so on and so forth, which are all internal factors that we have, which we do believe we have those levers. First half, if you look at, for the first half, we had average operating margin of 24.5%. And if you look at the last couple of years, we have always said that, look, our medium-term focus on operating margin is 24 to 26%. And in a fiscal 16, we ended up at exactly midpoint, 25%. In the first half of this year, we have had 24.5. So given the revenue trajectory for the balance of the year, we expect it to be in the range of 24 to 25. So that's what, of course, having said that, our focus on the operational efficiency levers we have consistently demonstrated over the last couple of quarters. We'll continue to focus on that. There could be quarter-to-quarter volatility, but the trajectory of those operational efficiency indicators are extremely important for us. And we do believe that we'll leverage them, including some on-site optimization and so on and so forth.
Hi, this is Sajid here from Bloomberg Quint. Vishal, I just want you to elaborate a little more on the guidance part, because you had 10.5 to 12% as guidance in Q1. You brought it down to 7.5 to 8.5 in dollar terms. So there's a 300 basis points dip on the lower band. And is it entirely because of RBS, or there are other headwinds which is forcing you to bring it down by 300 basis points, because the market was looking at somewhere around 150 to 200 basis points impact on your guidance because of this? The second question was on value compression on large deals as you go for automation. Are you seeing that happening in the market? For Praveen, one question is on impact. How do you see the retail and the BFSI space working? Because industries, IT players are talking about retail suddenly going off the growth path, and BFSI is going to be a challenge there. And when do we see the ramp down of RBS order happening? Is it going to be in second or and spread over how many quarters will that be? And for Ranga, can you just give a little more color? You said that the target is 24 to 25%, and you expanded your margins by 80 bips in Q2. Can you just break it down for us? Where is it coming from?
So on guidance again, it depends on what is going on in a present situation. So of course RBS is one part of it, but there are other aspects of it. Some of them are internal, some parts of some service lines not growing as fast as we had expected, and so forth. But generally, when you look at the at a guidance, it is the overall situation, and there are three major factors there: the client-specific situations, the structural situation in the industry, which is related to your second question, which is around the price compression and the impact of automation and so forth, and this downward spiral that I have talked about over the last 2 years, and that contributes to lowered economics. And then the third one is internal factors around some of our service lines, where the need for transformation and renewal is higher than in other areas. So all those bring us to the point where in the near term, we see what we see that gets us to this 8 to 9 constant currency for the year. So that's how we see the remainder of the year developing. In terms of automation, I think that this is a very fundamental part of the work that we do going forward, and I'm very happy with the adoption of Mana that we have seen. The successes on the revenue growth from Mana is almost negligible. However, the adoption of it by clients and the successes that we are seeing are very encouraging. We added a large number of additional Mana clients that went into production over the course of Q2, and the productivity improvement that they see as a result of that is starting to show results. So even though we are still in the early stages of automation, we are quite encouraged by the progress that has, and my sense is that as Ranga and Praveen talked about the operational efficiency parameters, those continue to help us, but the structural impact that we will see in the work that we do in the industry will come from automation, from AI technology helping to improve the productivity of our people dramatically, and that is going to be crucial for our future.
In the BFSI, in the last several quarters, we have had very good performance. Despite the challenging environment, what we are seeing has been there for the last few quarters as well. But we have been helped with our diverse portfolio across regions and across markets. That has helped us in good stead. Having said that, we had this in Q2, we had this blip on RBS. The ramp down will happen in Q3 onwards on the particular piece of work we have done with RBS. And we are also seeing some couple of headwinds in a couple of accounts on the BFSI side. So while we have had good performance in BFSI over several quarters, we expect it to be a little bit muted over the next couple of quarters till we recover from the headwinds that we are seeing today. And from a client perspective, there continues to be, apart from the cost pressures, there continue to be a lot of investments in terms of adoption of cloud, in terms of improving customer experience through digital. There is a lot of investment in blockchain, cryptocurrencies, and so on. So we continue to see investment, while on the operation side, we continue to see a lot of pressure on the cost side. We are, in the long run, we are definitely very comfortable on the BFSI space. In fact, of the 6 large deals when I talked about, 3 were in the BFSI space. So barring a softer, probably 1 or 2 quarters, we are fairly comfortable on BFSI. On the retail space, it continues to be volatile. The consumer spending is very choppy. In the US also, it's a slowdown in some sense because of uncertainty around elections. Then you have the Brexit and so on. So there continues to be some amount of volatility and softness in the system. Clients continue to spend on digital, on some of the newer areas like virtual reality, multi-channel, and so on. And some of the investments we have made in Mana, or investments in Scava and other things, Panaya and all, are finding a lot of resonance in this space, because what we are seeing is increased spend on the capex side, but a lot of pressure on the opex side, and we are seeing a lot more traction on our product side of the business. And on the CPG side, they are more global in nature, and because of the strengthening dollar, they are facing challenges in markets outside US. So there also there is a lot more focus on efficiencies. There are also investments in direct to consumer and so on. So we expect the retail thing to be a bit choppy over the next few quarters. But having said that, as I said earlier, while growth has been very moderate for us in retail, from a market share perspective in the last few quarters, we seem to have done relatively well when compared with competition.
Yes, I think we are very happy with our margin improvement this quarter. As you know, margin improved on the back of a lot of improvements in the operational efficiency parameters. For example, the utilization increasing to 82.5% and on-site mix coming down by 0.2% helped us overall on improvement of operating margin by 1%. And on the negative side, we had higher third-party software costs, which reduced it by 60, so the net 40. In addition, we had on-site cost optimization measures and so on and so forth, and which was partially offset by higher variable pay that we paid this quarter, and also some of the compensation that we announced for the senior management and so on. All put together, net-net, the impact on the margin was improvement in 80 basis points. I think primarily what we are seeing is that we have been saying this for last couple of quarters. Look, there are levers in the company which we need to fully optimize, whether it is utilization, whether it is on-site mix, whether it is role ratios on-site. Subcon expenses again have held, and it has come down from 6.3 in Q, 6.3% of revenue about 4 quarters ago. It has come down. So I think we have these levers, and we have always said that in the medium term, the operating margin, our expectation is 24 to 26%. In fiscal 16, we ended exactly at the midpoint, which is 25. And if you look at the first half of this year, we are at 24.5. And as I was saying earlier, operating margin is a derivative of 3 pieces. So one, of course, is the revenue growth, and the second one is the pricing, and the third one is how efficiently we can offset the pricing declines through operational efficiency parameters that I talked about. So given the revenue guidance that we have, we expect overall for FY fiscal 17, the operating margin to be in the range of 24 to 25%.
Gentlemen, Rukmini Rao from CNBC TV 18. A question to all of you. Vishal, one want to understand from you, the lowering of guidance that we're seeing. Is this very conservative guidance from Infosys? Have you left a safety net for yourself? And also in terms of the lowered guidance that for this quarter, in terms of visibility for Q3 and Q4, what is it looking like, and where are you seeing these headwinds that has compelled you to lower your guidance? Praveen, in terms of the impact of RBS and also the ramping up of other deals, if I remember right, in the last investor call, you were talking about better sense of it by the end of September or so. I want to understand from you what exactly has been the impact of RBS, and also in terms of ramping up of large deals, what is that looking like? And Ranga, if you could break up the margins expansion that have happened, how the 80 basis point come about? Thank you.
Sure. So in Q3 traditionally is a weak quarter because of the less number of days, furloughs, and so forth. So beyond that, we had a compounding effect of a couple of these declines of the clients that we have talked about, and so that contributes to a large degree to what we see happening there. Again, as to the conservative or not, and managing expectations, etc., I have always said that our approach is to minimize the asymmetry between what the management sees, what the three of us see, and what we share with the markets. And this is what we see presently based on the situation that we have. We will continue to focus obviously on strong performance, and in particular, as Praveen said earlier, with the capex improving and the ability to sell new products, some of these will, I believe, compensate for some of the the headwinds that we see. But based on the visibility that we have presently, we are comfortable with the 8 to 9 for the year on constant currency. So that is fundamentally the situation. Beyond the 90-day cycles, the underlying pattern in the work that we see is governed by bringing in automation into the work that we do, using our AI technology, our platform Mana, as well as doing completely new kinds of things, both by innovation coming from our employees and the new structural things that we are doing with our software platforms and so forth. And accelerating those is something that is crucial to our success. I think all of these will add up to performance as we go forward, but presently, based on what we see, this is our guidance.
On the RBS, we had about 3,000 people ramped down starting this quarter, and these people are predominantly in India. So from that perspective, I mean, this is what we said earlier as well. And from a ramp-up perspective, as and when we win new projects, as and when we see ramp-up of existing large deals, some of these people will start getting absorbed us. So we have considered the RBS ramp down, we have considered the headwinds that we are seeing, we have considered the large deal ramp-ups that's happening today, we have considered the large deal pipeline as well in arriving at the estimates, in arriving at the guidance. So all these are already reflected in the guidance.
But you said, in the JP Morgan, of course, and you went on to say that you'll get a better sense of how the ramping up is happening. So if you can, give us a sense of where, in which verticals are you seeing the ramping up happening?
From an overall perspective, I think we are facing some softness in, as I said earlier, in the financial services, but in the energy, in the ECS space, both in energy and utilities as well as in telecom, we are seeing better traction. And healthcare, obviously, we had a good Q2 and will continue to see a good ramp up in Q3 as well. Insurance, while BFSI overall we may see some softness, we are seeing better traction in insurance as well.
Hi, as I said earlier, I think the operating margin improved this quarter by 80 basis points on the back of several operating efficiency indicators, whether it's utilization, on-site effort mix, subcon, employee costs, and some of the on-site optimizations that we did, which helped us. For example, improvement in utilization and on-site effort mix improved the margin by 100 basis points, which was partially offset by higher third-party software costs of 60 basis points. And the balance 40 came through the on-site optimization that we did, which has also helped us during this particular quarter, and lower visa charges as well. And the other thing that I need to really emphasize here is that we have a very healthy operating cash flow generation in this quarter. It touched $550 million, and for the first half of this year, the operating cash flow crossed $1 billion. And at the same time, we have seen a better collection of our receivables. Our DSO came down to 64 days as compared to 66 days. And as you know, we have also announced an interim dividend of 11 rupees per share. I think we have leveraged all our operational efficiency indicators quite well in this quarter. And if you look at the trajectory of these indicators over the last couple of quarters, we have said that we want to focus on them. There is need for improvement here, and we have done that. And while there could be quarter-to-quarter volatility, we do continue to focus on these indicators.
Vishal, finally, analysts have kind of raised some questions around the kind of executive top management that we've seen. If you can share your thoughts, is this the end of it, the seventh exit, eighth exit that everybody talks about? What is being done to stop attrition at the top management level?
I am actually quite comfortable with our leadership team. If you think about the situation that our industry is in at present, we need to go through a dual transformation, both of the work that we do and what is happening in the world around us and the world of our clients. This is not an easy transformation. typically, I mean, if you just look at in the last 10 years, the number of Fortune 500 companies, I think something like 168 of the Fortune 500 companies are not there anymore in the Fortune 500. All of them had innovation departments, all of them worked with, you know, big time consultants and so forth. When you think about the nature of innovation in the times that we are living in, it calls for a complete rethinking, and even the companies that manage to transform themselves through this time do it on the basis of an existing cash cow business by leveraging that to fund the new areas and so forth. And we don't have that in our industry because the cash cow business itself is the one that is under margin pressure. So this is it's a time that we are in our industry that requires a deep sense of understanding the nature of our transformation and the ability to execute on that transformation without disrupting the business on a day-to-day or a quarter-on-quarter basis. So most of this management comes from within. Every once in a while we hire from the outside, and it is essential to maintain this kind of a balance, and not everyone manages to make it through this. Now, we are an extremely dignified company, and so you know, we wish the employees who have left us very well, but we have to continue the execution of our business, the execution of our strategy. And I am extremely happy with the management team that we have, myself and Praveen and Ranga, as well as our 4 presidents, Mohit, Sandeep, and Ravi and Rajesh. And now with the establishment of the industry heads on the sales side to further scale and decentralize and improve the focus on accountability on the sales side, just as we did 18 months ago in defragmenting and establishing accountability on the delivery side, I am quite satisfied with the work that we have done. Also, perhaps Praveen or Ranga can talk about the stock options and RSUs plans that we have put together. We rolled it out to the executives a quarter ago, and now we have added an additional few layers of management that we have 425.
High performance.
So these are all signs of a company that is dealing with this dual transformation in a very purposeful kind of way. If you look at our overall attrition, that has come down further, and if you look at our high performer attrition, last quarter I mentioned that the high performer attrition was 11.5%. Now it has come down to single digits to 8.9% because of a very dedicated focus on retaining the top performers across the company. So on all of these signs, we are making great progress, and I am extremely proud of the leadership team that we have presently, and I'm confident that we will continue to be able to execute on our strategy. We'll continue to obviously hire outside talent. Sangeeta is joining us on Monday. She brings great experience in healthcare as well as in global execution. Sanath just joined us last week to run our Finacle business, and similarly Robin joined us to run our leadership team from GE. So these are all, we have to continually expand our management bandwidth, enrich ourselves with new talent from the outside, which brings in different perspectives, and I am one of those myself. I am here now for 2 years and a quarter. So we'll continue to do that, but overall I am extremely satisfied with the way our management team is taking shape for the times ahead.
Madhu from BTVI. Segmentally, what is expected to outperform in second half, and what is the outlook on client addition?
What is the question? On the outlook on the second half,
segmentally, what is expected to outperform in second half, and what is the outlook on client addition?
Okay. So in the second half, I had responded earlier. I'll reiterate. We'll see some good traction in insurance in the BFSI space. We'll see some good traction in the healthcare vertical. We'll see good traction in ECS across energy and utilities as well as telecom. So these are the segments where we expect to see good traction. Rest of BFSI will probably be muted over the next couple of quarters because of RBS and other headwinds. Retail difficult to predict. It will continue to be volatile. The first quarter was good, second quarter was a bit choppy, so retail will be a bit volatile. Manufacturing quarter 3 is traditionally a weak quarter because of the furloughs, but we expect it to pick up in quarter 4.
So I think, look, for BFI, Chandra, we had a very good quarter, right? We grew at over 5% quarter on quarter, and we had significant client additions. We had significant large deal wins. Now, growth was also, pretty much across the board, right? We grew across geographies, and like we mentioned, we see some potential headwinds in the second half of the year, but growth was consistent across geographies and across clients. Did I answer your question?
No, Q3 and Q4.
Yeah.
Hi, Sandeep. Can you hear me? Last quarter we spoke about the challenges that retail is facing, especially US-based retailers are going to face, and we see that panning out in the second quarter. What is the kind of outlook you have for the retail sector?
Yeah.
And one for Mohit,
Yeah.
in the BFSI space, RBS has been a big blow in
Yeah.
terms of revenue for you guys, and Mr. Sikka also spoke about some headwinds which are coming in. Can you just elaborate on those headwinds?
Should I finish? Or?
No, that's right. So in retail, we continue to see very choppy consumer spending. If you look at consumer spending for August, it was flat, but now early reports from September looks like it's coming back. And if we have a good holiday season, obviously that changes everything. But fundamentally, retail as an industry is getting disrupted. We saw large retailers come out very publicly and say that they're changing their business model fundamentally. They're going to look more like e-commerce companies. So the nature of spending is going through a big disruption. If you look at consumer goods, which is very closely linked to retail and counted in the same vertical, these companies are adopting automation and reducing their employee size dramatically. The top 3 consumer goods companies in the world have never had a smaller employee base than ever before. So these 2 industries, and then in transportation, we saw a large shipping liner in Korea just collapse, basically because of overcapacity. So transportation and shipping is also not going through a great time. These are choppy industries. What is Infosys doing about it? If you looked at Q1, we grew these industries by more than 5.5% and perhaps captured more market share than anybody else in the market. That showed tremendous investments that we've made, especially in digital, along with Ravi, and in acquisitions like Scava, etc. These industries have been the first to adopt automation. They have been the first to adopt new software as well. If you look at Q2, this quarter as well, while the headline reads that it's almost a flattish sort of quarter for retail CPG, I think if you look at the market, many other market players have shrunk. So in terms of capturing market share, in terms of capturing incremental revenue over Q1 and Q2, and scrapping it out for revenue in a tough market, I think we've done well. I think Q3 is a seasonally weak quarter for all of retail, logistics, CPG in general because of the holiday season. But I continue to believe that the way we are leveraging our investments in the market, we will continue to gain and capture market share in these industries.
Are you also facing value compression in this sector? Because as you take up automation and artificial intelligence, the value of large deals are going to shrink.
Yeah.
And discretionary spending is almost nil or very minimum. So are you seeing that kind of challenge apart from this economic headwinds which are coming and hitting you, this kind of headwind as well?
I think discretionary spending in retail, CPG, logistics, and for that matter manufacturing, I don't believe that it's going to get tight as such, but the nature is going to fundamentally change. So if I approach these discretionary spend buckets with a traditional IT services mindset, my reaction will be, oh, it's becoming tight, it's going nowhere, etc. But if I approach it with a people plus software mindset, then I would like to believe that these industries will spend in a very select manner, in a very different mix of CapEx and OpEx, in differentiated software surrounded, which is amplifying the services model in a unique way. Our attempt is going to be to capture that second type of discretionary spend more than anything else. So it's not as much in terms of discretionary spend shrinking versus discretionary spend changing in its fundamental nature.
Mohit?
I think, yeah, on the financial services side as well, look, again, everything is relative, right? Performance is relative, and you've seen the numbers come in from our competitors, and you've seen the outlook that they've given for the quarter and for the whole year. So from that perspective, we've really had a sterling first half of the year, right, in financial services. If you look at, like I mentioned, in Q2 itself, we had 5.2% constant currency growth, which equates to, I think, double-digit year-on-year growth. If you look at the number of client additions, we added 13 clients. Praveen spoke about the fact that if you look at the large deals, and we've really had a remarkable quarter this year in terms of large deal wins. something like 60% of that came from financial services. So obviously in the first half of the year, the message that we have for our clients, you know, like Sandeep mentioned, right, the software plus services message is really resonating well, even in a challenging environment, right? So on the renew side, with all the work we're doing on automation and industrialization, and on the new side, all the work that we're doing on digital, on design thinking, on transformation, that is really resonating with our clients. Obviously, as we look to Q3 and Q4.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.